Welcome. This looks to be a popular topic tonight. We had over 100 RSVPs, which is rare in this long-winded age of Zoom meetings. So I think that's probably because of like Dave said, the star power here of our guest speaker and perhaps a little bit of interest in the data that we're going to be presenting tonight. If you have not joined us before, this is For Investors by Investors Long Beach chapter. And we're an investment, real estate, education, and networking club, all about just getting together, learning about the craft with no sales pitch. My name's Anthony Walker. I am a local multifamily broker here in Southern LA County and Northern Orange County, if you haven't met me before. And I run a company called Buckingham Investments. We specialize in helping investors learn, plan, and invest right here in the LA area in multifamily properties. I'm also an investor myself, so like to practice what I preach, pick the buildings up and get right in there. I'm not just a sales guy. So that's been a lot of fun to grow a portfolio over the last 10, 12 years. It's been an interesting market. Tonight, we are going to give a mid-year market update from a ton of research. I'll be covering the multifamily side. Dave's going to cover the single family side. I'll let him introduce himself in a minute, but he's also going to talk about some upcoming FIBI events you should be aware of. And of course, if you don't know already, Dave is also the chapter leader of the FIBI South Bay meeting that meets up in Manhattan Beach normally. So Dave, I'll hand it over to you.
Awesome. Thank you, Anthony. Good to be here. Glad to see so many people. We've got some great data to share tonight. And, if you missed some of the early chatter, if you're just logging on here, even on the residential side, it's been such a crazy, it's been a crazy 18 months, but the last 6 months have just been, such an anomaly in the market, but things are changing. So it'll be interesting to kind of walk everyone, through on the residential side where things are at. So a couple events, and I'm going to post some links in the chat here if I do this properly. So first of all, next month, as Anthony mentioned, I do run FIBI South Bay, and we are doing a multifamily panel next month, East Coast versus West Coast. So we've got your very own Anthony Walker representing the West Coast side of things. And then Bob Couture, who basically does syndicated investing, multifamily deals back in the Boston kind of Northeast area. So it'll be a really interesting conversation to kind of, hear about some of the geographical differences on what they do, and where Anthony's, doing more direct ownership, Bob's doing more syndications and passive investing. So should be a great conversation on multifamily. I just posted the meetup page on the chat here. So please join us. In September, get ready. We're actually going to do an in-person FIBI chapter-wide networking event on September the 23rd. It's actually going to be up in PV. Ivan, you should be thrilled. You can probably walk there. It's going to be up in PV, and actually, Anthony and his wife Meg have a new space up the Lavetta Inn, which I'm sure he'll talk about in a little bit. But it's just super cool kind of venue space in Malaga Cove. There'll be a lot more information that you guys will get. We're probably going to announce it in about another week and a half. But September the 23rd, an in-person networking event. There will be no education, no presentations. It's just a chance for people to kind of get back together and start doing some networking. Hopefully we'll be, we'll be outdoors and maybe a little bit indoors, depending on where things go with our Delta variant. So that's to come. You'll get some more information on that. And then lastly, for those of you that have either heard of or participated before, FIBI is also, we have a conference that we've been a part of called the Intelligent Investors Real Estate Conference. It's going to be in the fair city of Manhattan Beach, California next year, 2022. We're actually officially announcing it to the general public on Monday. It's going to be January the 20th and 22nd. And I just posted the link up. It's a 2-day event or a 3-day event if you opt for the VIP day. And it's a really, high level. I always call it kind of FIBI on steroids. It's just 2 days of panels, great keynotes. Actually, last year Anthony was one of our key sponsors. Did a fantastic keynote on the long-term benefits of owning individual properties and real estate. So I just put the link up here. If you're on our list, you'll probably get 100 emails in the next 6 months on it. But we highly encourage it. It's a fantastic event, and it will be in person in Manhattan Beach. So that's what I have for announcements.
I love it. I'm excited to get back to IREC in person. We pulled it off on Zoom this year, but it's going to be great to get back in person. I'm sure that we will be there as we have in years past. So before we get started, to give a little teaser, Dave mentioned this, but I'm just going to show you we have a unique opportunity for this networking event in September. You may not understand the treat. So normally we would not be able to afford to rent a venue like this.
We can't even afford to rent a Winnebago, let alone an event. Let's be honest.
So don't let the beauty of the event venue lead you astray and think that this isn't a nonprofit, because it is. So we happen to be very fortunate in that my wife owns a catering company, and she's just taken over the lease for the La Venta Inn up here in Palos Verdes. They are not taking dates open to the public until October. So we are going to be the trial run for a newly remodeled, relaunching La Venta Inn, which we would never be able to afford and won't be able to book next year. So hopefully you can join us. I'm going to just share for a second to give you an idea. Here's my shameless pitch for my wife's business. But this is where the event's going to be. Gorgeous ocean, coastline, Queen's Necklace views. Come check it out. It's going to be awesome. We will charge a very nominal fee for the door to pay for food and so on, but it's going to be great. We'll get registrations and stuff all out for that. But without further ado, I know everybody is here to hear about market data, because we're all trying to make sense of where the market is going and what is happening out there. I'm happy to see we got a strong showing tonight in the guest list. So we're going to jump right into it. I have prepared a PowerPoint deck that we're happy to share with you. If you want to shoot Malcolm an email, Malcolm, if you want to put your email in the chat, or if you want to just email info@Buckingham Investments, we can email this over to you when we're done. Basically what this is it's data from two separate sources, before I confuse everybody by opening up a bunch of charts, because we're going to get into it. Buckingham does our own local market research every quarter on the multifamily market, and we correct all the errors that you see on the MLS, which are numerous. We eliminate some outliers that would skew the data considerably. We correct the income, fill in vacancies and stuff like that, and we publish this data every quarter, and it goes all the way down to 2 units. So typically, if you're reading multifamily data, either from the paper or other, like larger commercial real estate investment brokerages, you're really only reading about mostly larger deals, especially 5 and up, or even larger than that. So our data is interesting in that it incorporates 2 to 4 unit properties as well. So expect that it's going to look very different from what you might see in some of that other stuff. But the nice thing about it is it drills right down to individual local cities, neighborhoods, zip codes, property level detail. So we can get all that over to you if it's something that you're interested in. And it's something that we started doing as I was building my portfolio, because I just felt like there wasn't a great data set out there for individual investors. Buckingham's been doing this for over 50 years and keeping track of this stuff, but we've got a little more robust data set over the last 10 years. So that's going to be the first section of our talk. And what we're going to cover today is what we call the Greater South Bay. That covers from about Inglewood down through Long Beach. We also do the same research for the rest of LA County, but it's not finished yet for Q2, because that's a huge project. So if you're interested in the rest of LA County, we have that up through Q1. We can share that with you as well. We've got some trend lines and charts that we'll look at. The second part of what I'll show you is a bunch of data from CoStar. So if you don't know what CoStar is, they are the commercial real estate data monopoly, for lack of a better term. They have all kinds of great data on demographics, income, job growth, that kind of stuff that a lot of the larger players use to decide what markets to enter, comparable sales, all that kind of stuff too. So we'll look at the broader level from the CoStar data that recently came out too. So that should give us a really good sense of the multifamily market. After that, I'm going to toss it over to Dave, who is a single family expert here locally. I only dabble in that space, so I can't pretend to know what's going on. And my heart goes out to those of you who are trying to buy a house right now anywhere in this area. So I'm sure he'll unpack that emotion a little bit. So without further ado, let me open up my slides. All right, everybody can hopefully see my screen. Here we go. So first of all, for those of you who have not been to one of these before, or maybe you haven't attended a investment education type meeting, this is just a few simple equations I like to cover every time we go over this, because this might all sound like Egyptian to you if you don't have experience with multifamily. So 3 super simple metrics you ought to know about. Gross rent multiplier, calculated as a property's price, value, or value divided by the gross scheduled rents. So the gross scheduled rents are just the annual rent roll on a building. So if you had a 4-unit property that each unit was rented for $1,000, $4,000 a month, $48,000 a year, that's the gross scheduled rents. So price divided by gross scheduled rents. And that spits out a multiple. Another way to look at that is it's the dollars in purchase price you're paying, or you buy a property at, or it's valued at, for every $1 in rent revenue. So this is a really simple back of the envelope metric that you can use to value a property. If you have nothing else but the annual or even the monthly rents on a property, and you know the local GRM for that area in that property type, you can approximate a pretty good value with that. And so just depending on where it is, you'll kind of see how to do that today. If you say your market GRM is 15 and there's $100,000 of gross scheduled rents, your building's worth about $1.5 million. Pretty simple. Cap rate is the net operating income divided by the property's price or value. So you hear a lot of talk about cap rate in the commercial real estate space, the multifamily space, syndications, private investments, or direct investment. Cap rate's a good metric because it's the net operating income and on the income side rather than the gross scheduled rents. So this is after the expenses are backed out, which means that you could compare a property that has a whole bunch of landscaping and an elevator and a security guard to one that is just a little building on concrete with none of that, because the first building is going to have a higher expenses, but you could still get a comparable cap rate between the two. Because the income's in the numerator of the equation, on the cap rate, it spits out a percentage. And another way to look at the cap rate that a lot of people like to use it to compare to other investment types is it's a yield on the invested capital. So it ignores the debt, it ignores the mortgage payments, so that you can compare properties to each other and analyze their yield based on properties of a different type, in a different area, different market, different asset class, all that kind of stuff. And at the end of the day, it's really an expression of risk. So you see a lot of low cap rates in Southern California, and you'll see some low cap rates here tonight. That's because investor dollars see, for the most part, real estate around here is a really low risk investment for some pretty obvious reasons. There's, high barriers to entry, really hard to add additional supply, incredibly diverse job base and demand for the properties, right? Whereas investing somewhere in the middle of nowhere, you're going to experience a higher cap rate because there's more risk. So we use cap rate as well to value properties and compare areas to each other, property types to each other, in the same way that we use GRM. The debt coverage ratio is not specifically in our market data, but it's something to be aware of when you look at these metrics, because it drives where you might want to decide to invest. So a debt coverage ratio is what a commercial lender is going to use to do commercial loan underwriting. Generally, they will give you a loan up to an amount that supports a 1.2 debt coverage ratio or higher. And what that means is the net operating income divided by the annual debt service, which is just the annual mortgage payments, needs to equal a 1.2 or 120% of those annual mortgage payments. So that's commercial lenders forcing you to cash flow on your building. And if you realize and think this through a little bit conceptually, the lower the net operating income is relative to the purchase price, or rather the lower the cap rate is relative to the purchase price, the less debt that property is going to qualify for. So that's kind of a key interrelated concept to understand as you look at and compare some of these local markets and where you might be interested in investing. So my 2 cents there on some of these metrics and just how you look at them. So before we dive into the details and look at the quarterly math, let's just check out what our current 55-year compound rate of appreciation looks like right here in the South Bay. So this is our own research, 2 units and above, residential income from the MLS going back to 1965 from about Inglewood down through Long Beach. And it's in price per square foot because that's the easiest way to just illustrate percentage appreciation over a long period of time. So 1965 buildings were trading at $14 a square foot. And we've got all these business cycles, recoveries, recessions, and so on. In 2020, we averaged $422 a square foot on this type of property. That's significantly lower than you would see in a lot of the single family properties in the same area. Apartment buildings are generally a little bit cheaper for the space just because the value is more based on the income, but this is a good way to measure appreciation over time, and price per square foot can be important. So over 55 years, we've averaged 6.4% appreciation every single year. If you were to just smooth this out all the way, it's 6.4% annually. This chart is one we could probably spend a whole hour on itself because we've got 4 or 5 business cycles in here, and we could talk about the economic factors that drove each downturn, how real estate got dragged into that or not in some cases, or maybe caused it in one particular case I could think of in recent memory. We won't get into that too much, but suffice it to say, yeah, you can see 2008 was pretty bad. That's the one we caused. On the other hand, the previous recession right before that was in 2001 in the country. We didn't even notice here in local real estate values. That was more isolated to the stock market and company performance and stuff like that. So it's an interesting time. We're going to come back to this decade, the 1970s, a little bit later, because there's a lot of talk out there about inflation right now. So I always want to cover that about what could happen if we're back there. I don't know if that's what's going to go on or not. That's economists' domain who are much more highly educated than myself. So we'll just look at some local stuff. All right. So now straight to it. So this is the most recent local market study for that same area. Again, Inglewood down through Long Beach. This is every apartment building sale that includes duplexes on up that was from the MLS from April 1st through June 30th. So second quarter. And so this is not just our company, this is everybody. So you've got volume, 335 total transactions, average gross rent multiplier. There's that metric again, if you don't remember it. So it's $18.50 on average for every dollar of annual rent revenue that investors are paying in this broader submarket. Average cap rate is 3.7%. Price per square foot was $496. So if you were paying attention to the last slide, our average for 2020 was $422. Already second quarter, we're at $496. So things are going very well. Average price per unit at $442,000. Now, this is an interesting chart and a good way to look at it because a lot of people like to look at market data on like a broad metro area sort of method. And that's the way you see it published in a lot of studies. And you could say, you know, Los Angeles market, here's your cap rate for Los Angeles. But that doesn't really do anything for you as an investor, right? Like if you're just moved to LA and you want to invest in a rental property here, what the heck can you do with something that calls Beverly Hills the same market as Lomita? That's the first city I saw when I looked at the chart, not to pick on Lomita or anything like that. But so it's really interesting to compare these on a more detailed level. So you start to see how these metrics play out. So Hermosa Beach, right? I'm going to pick on Hermosa Beach because it's expensive. 13 sales, 28.6 times gross, cap rate at 2.4, average price per square foot of $1,315. There must have been like a sale on the Strand or something that was a duplex or a 3-unit, because typically Hermosa Beach is actually not as expensive as Manhattan Beach, but it's close. So, you know, you got to make sure the numbers aren't getting skewed. They might be a little bit just on this quarterly basis. Average price per unit over 1.1 million, almost 1.2 million. On the other hand, Long Beach, 156 sales, so a lot more volume, 17.7 times gross, 3.8 cap rate. San Pedro, much better, 4.2 cap rate, 16 times gross. Gardena, Harbor City only had one sale, but that's actually pretty representative of what you would see there. and then Wilmington at 4.3. So the cities that generally you would consider to be a little less desirable, less expensive in the single family market are similar in multifamily. They're higher cap rates because investors see them as a little higher risk areas to manage, but you get more cash flow. And then that flows through that debt coverage ratio calculation. So buying a property in Hermosa Beach, you basically can't buy anything with a loan. There's 2.4% yield on the total capital left on that property to service any debt. And when you take the interest rate plus the amortization, it's not going to work. But you can probably make deals work in a lot of these other cities. So we like Gardena, Harbor City, Hawthorne, Inglewood, Lawndale, Lomita, Long Beach, San Pedro, Wilmington. Those are good markets to pay attention to here locally if you're trying to use good leverage and pick something up that's going to pay for itself with 25 to 30, 35% down. Those are probably the markets that you want to look at. Cap rates is same side of that, other side of that coin from the GRM. So this is just all up the quarterly market data. Now within here, as I mentioned earlier, we have 2 to 4 unit properties, and then we also have 5 unit and up properties. So I'm going to show you how the math splits out now. And this gets really interesting, especially what's going on currently with the debt markets. So here's the 2 to 4 unit sales. So out of 335 transactions, 282 of them were small 2 to 4 unit properties. So the vast majority of the properties that are changing hands right now are these small 2 to 4 unit properties. That's not unusual. There's just more of those around. They're pretty common, but it's particularly pronounced right now. The GRM on those properties is 19, which is significantly higher than that overall average. The cap rate was 3.6, price per square foot, 518, price per unit, 475. So much higher than the overall average. And you can see which cities had more of these. So remember, Hermosa Beach had 13 sales total. Looks like all of them were 2 to 4 unit properties. So you kind of see where the makeup of what was built in these cities come through. Now here's where the interesting piece starts to come in. So watch the GRM and the cap rate here on the 2 to 4 unit slide. And then here's the 5 and up. So 2 to 4 units, 19 times gross, 5 and up, 15.5 times gross, 4.3% cap rate versus 3.6% cap rate. So really interesting here. 3.5 full multiples on GRM versus price. That means if you had a 4 unit property generating $100,000 on average in this market, it would be worth 1.9 million. And if you had a 5 unit property next door that was also generating $100,000, it would be worth 1.55 million. That's a huge spread between the price of those two different types of assets. And the reason for that is that right now, that residential debt is so cheap. 2 to 4 unit properties are financed with the same type of debt that you get on single family homes. So the debt on that right now, you can get like 3% flat. It's a little higher for an investment loan where you're not owner occupying the unit, but owner occupied is a great way to get in. I think FHA is probably still in the 2s. If you have lower loan amounts and you're within conforming limits and you have good down payments, I think you're in the 2s on conventional as well. So huge premium on price as a result of the ridiculously attractive financing. The other great thing about that debt is it's fixed for 30 years with no prepayment penalty. So it's not unusual for us to see a big spread there between 2 to 4 units and 5 and up. That's typical, but a 3.5 multiple spread is huge. That's really large. I think some of that is definitely wrapped up in the data from some of those nicer cities. So, we had a significant number of sales in the beach cities, which is going to pull the overall average up. So you can look at it city by city too. So Long Beach was at 14.9 versus 18.2. Almost as bad actually when you look at it, but not quite. So it might be pulling it up a little bit if you look at it city by city. But this is a really interesting point. So you do get better yield on the 5 and up properties. You get better cap rates, but the debt, the interest rate's still really good there right now. It's about 3.25, 3.35 for a 5-year fixed, but those loans are not fixed for 30 years. They're fixed for 3, 5, 7 years. Generally you pick, there's prepayment penalties during the fixed period. It goes adjustable afterwards, and you expect to refinance or sell at the end of the fixed period typically. So it's a very different way to finance properties. These aren't resold generally. to Fannie and Freddie, unless you're getting agency debt to issue it at the beginning, which is for larger deals in a lot of cases. Our local market has a lot of really competitive portfolio lenders in this space, so the terms are good. But usually the debt on commercial deals is cheaper than the debt on residential deals. And right now it's almost the same. So no wonder the spread in pricing. I thought that was a really interesting point, so I spent some time on that. So now let's look at some trends going back a few years to just kind of see where we are. I know everybody's wondering where stuff is going in the immediate future, myself included. So we're just going to look at the past and maybe we'll make some guesses, but your guess is as good as mine. So here is volume, first of all. Now, the thing about volume is it's a bit seasonal. It's not nearly as seasonal in the multifamily market as it is in the single family market. But unsurprisingly, pandemic breaks out in early 2020, plummeting sales volume to levels that we haven't seen since before this chart. And then we come roaring back with all that pent up demand. So Q2 of 2021, we haven't had as many sales as we did this last quarter since the middle of 2016. That's pretty significant. That's a lot of volume. Now, I think a lot of that was probably people sitting on the sidelines. There's a lot of cash out there right now that's percolating through the economy. People are trying to figure out where to put that to use. Turns out multifamily is a great place to put your cash, especially if you're worried about inflation, which we'll touch on in a minute. And so no surprise, people now feel pretty comfortable about the direction of things and it's time to invest. And this is a pretty low risk way to do it. So I'm not really surprised to see that volume, but it's notable that it's so much higher than it has been for the last few years. GRM on a trend basis. This is an interesting one. So I've been saying this for the last 3 years or so. Despite prices rising annually, GRM has been basically flat for the last 3 years, even longer than 3 years. Really, since the end of 2017, early 2018, it's been basically flat and a little bit down. 2020, it went a little bit down when everyone freaked out and was trying to figure out what was happening with COVID, obviously. We've had this kind of gradual uptrend, and then we've been stuck here for a while. Now we've finally broken out of that, and we're above 18 on average. So this is, we're bucking almost a 4-year trend at this point. So we're entering new territory. Very interesting there. Cap rates, same thing. Cap rates the other side of the same coin. Basically flat going back to 2017, and now they're continuing to go down. And I think it's a combination of investors searching for yield. There's not yield available in any other assets, safe place for the money, a good hard asset type investment, basic human need, all that jazz that brings people to multifamily to begin with. And there's just so much cash out there. So I'm not surprised that this is going on. Price per square foot, up, of course. Ended at $496. We're almost over that significant 500 mark, and steadily up through this whole time. So price per square foot, we didn't experience nearly that same flatness. There was a little bit of back and forth here in 18 and 19, but 2020, the price per square foot didn't really dip that much. And I think that's really explained because rents have continued to be strong in our area. We'll look at some charts later on rental data in LA from CoStar, but rents did surprisingly well over this time period. So price per square foot continues to rise. And then price per unit, more of the same, up and away. No surprise. Almost to 450. Inventory is always an interesting topic. This is an easy one to forget about when you're looking at apartments. It's a more popular metric in single family, but it's good to look at in apartments too. So here's the number of active listings that we have on average each one of these months. And this goes back to March of 18. So this tracks a little bit more zoomed in space. And you can see inventory does have some seasonal fluctuations to it. The winter is usually the slowest months. People like to get their stuff on the market in the spring and summer, similar to single family, but it's not nearly as pronounced. But I can tell you as an investor and as a broker working in the area, it feels right now like inventory is super low in multifamily. Everybody complains to me. I talk to other brokers, I talk to investors, and everybody says, there's no inventory, there's nothing out there. That is not true. Inventory is thoroughly average right now. in the multifamily market, going back to 18. The problem is there's a disconnect between buyer and seller expectations. So we see this when there are changes happening in a market. And I think that's what's happening coming out of COVID, right? Is everybody freaked out in 2020. There were a few COVID specials that happened. And now prices have come back up aggressively. Sellers feel like their buildings are worth a lot more than they were even last year. They're probably right. But buyers still feel like there's uncertainty in the market. They should be getting a deal. We don't know what's happening with eviction moratoria and all that kind of stuff. And so the net result of that is buyers are not willing to pay huge prices that the sellers might be expecting. And so you see a lot of this inventory is stale inventory that sits on the market for quite a while with unrealistic sellers that think the article that they read in the paper about the single family market applies to their apartment building. And the unfortunate news there is that the apartment building buyers are generally buying for income. So if you don't have the rents, pretty hard to set a record price. So there's a lot of that going on. On the other hand, when you see really well priced buildings hit the market, multiple offers, 10 to 15 offers, best and final walkthrough, circus. If you've been to one of those, you know what I'm talking about. And they go way above asking. I think I lost out on a deal for some clients of mine a couple of weeks ago. We were $200,000 above asking on a small. This was over 10% of the list price. So that is definitely happening in the multifamily space where sellers are competitively listing. But there's a lot of inventory out there that's just got this aspirational price on it that's not going to go anywhere. So it's an interesting thing. It's an interesting story in that the inventory numbers don't really illustrate that. But as it is right now, you're not seeing a big inventory spike. So I don't expect the market power dynamic between buyers and sellers to be changing anytime soon. Okay, so a couple bits on inflation before we move on to the CoStar data from the LA area. So this is that same chart we looked at earlier, adjusted for inflation in 2020 dollars. So 2020 dollars, of course, is the same here for 2020, 422 a square foot. 1965 would have been $134 a square foot in 2020 dollars. So what this does is it backs out the impact of inflation on the market. So it's kind of an interesting chart to look at. A lot of the increase in value over time from properties that people buy is from inflation. So buying real estate is a fantastic hedge against inflation. Leveraging inflation alone is a decent way to make money. But here in this area, we have a lot of additional demand on top of the inflationary pressures that cause properties to go up in value. So you can see that upward trend is still there. And the decade that generally people like to look at when we start to talk about inflation is the 1970s. So let's get into that a little bit more. So here's a recession period and recovery going from 1967 to 1981. I dug this out of our old records. I've shown this a few times at other meetings, so you might have seen this before. But I come back to it because everybody wants to know what's happening with inflation and how's this going to impact their investments, and people are freaked, and I get that. So who knows whether the 7% annualized inflation that we just experienced is transitory in nature to give you Fed speak, or whether it's going to run away and get away from us and it's going to look like this, or whether it's going to adjust back down when the economy reabsorbs all of the unemployed people and we kind of go back to normal. I tend to be kind of in the latter camp. I don't think we're going to have runaway inflation. I think they're doing what they need to do right now, but who knows? I could be wrong. I actually hope I'm wrong, because this is what happens when I'm wrong. In the 1970s, this is interest rates for homes at this point, overlaid over price per square foot on multifamily property. So the concern I always hear from people about inflation coming back is, well, interest rates are going to spike and my values are going to go way down, which I never got. Because if you've got crazy inflation going on, you have rents rising and you have prices for everything rising, including apartment buildings. So I don't understand the argument very well. And going back to the last time that we had significant amount of inflation bears that out. So here in the early 70s, we had a recession, property values went down to $17 a square foot. And then inflation really started to kick in. They started to raise rates aggressively. And by the time we were in 1981, we were at $86 a square foot and 16% interest. and values just keep going up and up and up, and rates have to go up and up and up too, because they're trying to get inflation under control. But you see that it finally breaks a couple of years later, and it kind of levels off, and we had the next recession after that. But during that time period, we had a 406% increase in the value of properties. So if you think about that for a minute, even if you're getting in anywhere in here and you're paying 7 to 8% interest on your property and you're buying at these prices, if it triples or quadruples by the time it gets to there and your rents have gone with it, who cares about the debt service at 8%? That's my thinking on this whole thing. So I always come back to this when people are so worried about inflation and interest rates. I think we're going to be just fine. I don't think it's necessarily going to look like this again, but it's a nice case study to come back to and look at. This is a bigger increase than anything we've seen since then. I'm going back to my 50-year chart now. So the scale of this is confusing because this doesn't look like a big deal when we're on a scale of $20, but on a percentage change basis, $17 to $86 here was a way bigger deal than 114 to 329 from 95 to 2006, or from 205 to 422. So you have to look at that. And then we've got our little example here. Here's your inflation calculator. This is what inflation rate was each one of these years. 10-year average of 8.45%. And if in 1973 you purchased an item for $600,000, in 1981 it would cost or be worth $1.2 million from inflation alone. If you bought 600 grand worth of gasoline or milk, right? By the opposite logic, if in 1981 you had purchased an item for 600,000 in 73, it would have been 293. Pretty wild how that happens. We're starting to feel the effects of that right now. If you're trying to buy anything, if you went to a car dealership lately like I did, I'm sorry, it's bad. Or anywhere else, the lumber yard, although that's gotten better. So my 2 bits on inflation. All right, so at this point, let's get into some CoStar data before I turn it over to Dave. Thanks for your patience here. I'm sure this is going to go long tonight, but I wanted to get into the details because this is useful stuff for people. So CoStar does market level research really well. And the following charts are taken from their Los Angeles multifamily market report, to give credit where it's due. So this covers basically all of LA County multifamily, but this is really only in the 5 and up space. So if you see some discrepancies here between what you might have looked at in the numbers on our numbers to this, that's why. So you have overall and stabilized vacancy. The difference here is that overall vacancy would include new construction that's still in lease up, or buildings that have been vacated and are going to be released and remodeled. So stabilized vacancy is probably a more sensible number to look at. That's the orange. And here we are in the pandemic. Vacancy shot up from 4% to just above 5%, and now aggressively back down. We've absorbed those units really well. That's happened quickly. So vacancy is not a big issue. Here's what happened in the 2007, 2008 crisis. Took a long time for those vacancies to get down to where they are now, but we're seeing an incredible amount of demand, especially when we segment the asset classes a little more, which I will in a minute. So right here, actually. So CoStar segments properties into star ratings. This is like class A, B, C, like what you hear at other meetings. And so Los Angeles 3-star would be like class B and C type properties. 4 and 5-star would really be your A type assets, either new construction or highly amenitized buildings that aren't too old. And as you might expect, the 4 and 5-star properties really were the ones that got hit hard. So that overall chart really doesn't tell the whole story. And I've been saying this anecdotally throughout this time, but that kind of B and C class stuff here, the blue line, the lowest line, it did really well. There's nowhere else for these people to live other than move out of state. I'm sure we'll touch on that momentarily. But vacancies just remained super low there. We had a slight uptick. We went from around 4% to just over 6%, but then immediately absorbed again. I know in our property manager's portfolio right now, vacancy across about 3,300 units is in the high threes. So very, very low vacancy in this market right now. No problem with demand for units. The high-end stuff, they're giving rent concessions, but it's also aggressively coming back down, which is to be expected. Vacancy by bedrooms, kind of interesting to look at in the pandemic. A lot of people wanted more space. So here's that 3-bed line is the one I like to look at on this slide. The 3-bed line and the studio line tend to be the highest historically. It's really easy to rent 1s and 2s. Studios tend to have some turnover. 3-beds just take longer to rent because there's not as many tenants looking for 3-bed units as there are 1s and 2s. So usually those two together are on the higher end of the vacancy charts. Pandemic breaks out and the 3-bed line goes to the bottom because everybody needs more space to work at home or cohabitate, right? So that's kind of an interesting thing, even though it's at a small part of this chart. Studio rate, vacancy rate shot up, but again, they're all coming way back down aggressively now. And this is basically back to normal levels. And I think studios will be there again in, momentarily. So it's interesting to look at it by bedroom. Market rent per unit. You have Los Angeles effective and asking. So that's after concessions and discounts. Up here right at about $2,000 average per unit. Whereas nationwide, we're just under $1,500. I know I've got a slide later that breaks that out by bedroom type. So I'll skip for that. Here's the Los Angeles asking rent growth year over year chart. This is an interesting one. And this you have to think about for a minute conceptually too, as we start to have that inflation discussion. So you had strong rent growth. Anything above this 0 line means that in the previous year, from that quarter, year over year, there was that much percentage rent growth. So you did actually have rent growth slowing down in 2019. And we felt that happening. Rent growth was super aggressive in the middle part of the last decade. And the growth had slowed down in 2019. That doesn't mean it had gone negative. It just means that rent growth wasn't as aggressive. Well, of course, pandemic broke out, rent started to go down. So we had negative rent growth for 3 quarters in 2020. And then I think this is Q1 2021, basically flat. And now Q2 of 2021, which isn't labeled, but it skips quarters here, was above 2%. But think about what this chart means for a minute. So if year over year, Q2 2021 was at 2%, that means coming back here, we're 2% above where we were a year prior. So 2% above where we were in Q2 of 2020. So we're only 2% above that. We got a long ways to run. And I think it's going to start looking really aggressive as we come back from this. So it's an interesting chart to see how they measure that, but it's a little confusing. Again, nothing compared to this, what we saw back in 2008. Market rent per unit by bedroom. Studios averaging 1,500. 1 beds, probably I think 1,800 or so. 2 beds are 2,300. 3 beds almost 3,000. So this is across all of Los Angeles, and that would include really nice areas, Class A buildings, nice stuff. Rents continue to go up, basically barely down, practically flat for the pandemic, and now aggressively up past where we were. The job growth chart's a hilarious one. So I don't know if we'll see this again anytime in our memory, but United States and LA look pretty similar. Aggressive negative job growth to the tune of almost 15%, and an aggressive snap back year over year here with forecasted numbers. We need to move the forecast line, or no, yeah, that's Q3 forecast right here. That's estimated to top out in early 2022 and come back down to normal levels. So really confusing chart, but the big question is, right, how many of those jobs are gone permanently or shifted, or people are gone from the labor force, and what does the economy look like afterwards? So it's a hard chart to make sense of and really get a lot out of, other than, yeah, it was really bad, and yeah, now it's really aggressive, right? If you're trying to hire anybody right now as a business owner, you're feeling this. Employees have their pick. It's difficult. Median household income. Again, 2020 went up, which is odd, but seeing as they were handing out money, I guess that's what happened. So now we're thinking that I guess they're forecasting a bit of a dip as stimulus wears out and as the economy goes back to normal, followed by continued growth, both in LA and the United States. So that's kind of an interesting one. And you can see how much higher LA is than the rest of the US. Over 80,000 is the median income in LA versus, what's that, around 70 for the US. Population growth, and this is where the California naysayers love to come in. Los Angeles, year-over-year population growth went negative from 2017 and is forecasted to be slightly negative through 2023. Enter all the news articles about everybody leaving the state. And United States actually has a similar pattern, but less pronounced. However, when you look at the net population change by numbers, it's practically meaningless. So we've lost year over year at the bottom of this, and my Zoom window is hiding my year there. There we go. In 2020, mid 2020, we lost just over 60,000 people from the LA area out of 10 million. So, I don't think that's enough to move the needle on rents for apartment buildings or job prospects or any of that. And then it's forecasted to come back and go positive in the later parts of the decade. So that's the multifamily situation. I suppose let's actually have Dave give his section next, and then we'll take questions at the end so that we don't take too much time, since this is dense stuff. If you want to enter questions into the chat, we will take them as well. And as I mentioned, all those slides we can make available to anybody who wants them. So Dave, I'll hand it over to you to talk to us about the single family market.
Awesome. Good stuff. I am in the process here of, actually, I could probably do it this way. I've got my presentation on Keynote, which doesn't do very well sharing on Zoom. So actually, this will probably work. Oh, that's too much. All right. Okay. All right. So I'm going to go ahead and share this. And like Anthony did, I've got a mix of data sources here too. So what I'm going to kind of start off with is some NAR and CAR data before I kind of get into some of the local data. Just because I think it's important to, kind of look at, where things are on a national level, and then kind of drill it all the way down to the South Bay. So just real quick, a quick introduction to myself. I've kind of got three main entities I'm a part of. Capital Stack Investments is my development arm. We do a lot of real estate private equity deals, mostly infill construction projects here in Southern California. We're really focused on millennial housing, and as we go through some of the data, I think you'll understand why. I also run a real estate brokerage, real estate company under the Keller Williams brokerage name, Co-Real Estate Group. We focus on South Bay residential. We deal with a lot of investors, especially on the single family side. And we actually have a new home division. So we get involved in selling a lot of new construction projects. And then, as you guys all know, for investors by investors, I run FIBI South Bay Group, and we meet the second Wednesday of the month, which our next meeting will happen to star Mr. Anthony Walker talking about multifamily, both on the West Coast and the East Coast. So today I'm going to kind of look at things in four segments. First of all, I'm going to spend a little bit of time talking about what's kind of driving demand. I think we all know that there's demand happening on the residential side, and even as Anthony showed, there's demand happening even on the multifamily side as well. We're going to look at some national and state stats. I'm really going to dive into LA County because I think it's the best indication of where the market's going. And then a couple of slides on kind of the South Bay, Long Beach market as well. So, let's start off with what's driving demand. And it's really, it's really a pure demographic type of movement. When we look at the population by the end of 2019, you can see that the largest, the largest segment of people were the millennials, almost 72 million strong. And then followed right behind them are Gen Zs, right, at 67 million. So, as of the end of 2019, 47% of the United States population was under the age of 40. And I think why that's important is just from forget about the market cycle standpoint and think about it from a life cycle standpoint. What do people do when they're in their late 20s, early 30s? They get married, they start families, and they look to buy housing. So probably the number one factor that we have is just purely driven on the age of our society. We've got a huge chunk of our society, almost half of us, that are entering into the home buying world, and contrary to popular belief, millennials are not going to Airbnb and lift their way. They actually love owning property and are actively in the real estate acquisition market. Anthony, you were just touching on some of this migration. People talk about the mass exodus from California. And, I don't have a lot of the, last time we spoke back in January, I spent a lot of time talking about this particular topic, but I think what's important is even, historically, when you look at migration in and out of California, and the blue line here is net migration into LA County, the red line here is Orange County. And I didn't pick those colors politically. It just so happened how the chart was generated. But when you look at people between the ages of 20 and 24 and they're in their mid 30s, the migration into California has been positive. And then once people start getting a little bit older, into their 30s, 40s, and 50s, that's where all of a sudden the migration starts to go outside of the state of California. Except for, it looks like a couple of older people here are retiring down to Orange County. That's the lone outlier here. And that trend has continued. And the reason why is that, if you are a young, up and coming professional person and you work in the aerospace industry, you work in the entertainment industry, you work in legal services, you work in so many different kinds of industries that ultimately, or at some point in time, there's a high probability that there's good jobs somewhere here in Southern California or California as a whole, right? So younger people that are building their careers, building their wealth, are still moving into California. And Anthony, your graph that you had before that showed net migration out of California, I think a big part of that is because while people are leaving California to go to other states, historically what happens is they're replaced by people that are moving to the United States of America and settling in California because they have high professional jobs. And in the last 18 months, that didn't happen, right? What's probably going to happen over the next, and I would assume the rationale on what's driving those projections to have migration and population growth start growing again in California will be the fact that we start having international migration, and the majority of those people that come into the USA are generally relocating into New York, San Francisco, or LA, just because that's where those kinds of jobs are. So you've got a lot of younger people that are moving to California, and they're buying houses. As of 2020, which is the latest that NAR has this data, almost 38% of all buyers were, again, either millennials or Gen Y, Gen Z people who are just starting to buy houses as well. So I think the number one driver of what's happening with the demand in single family is just pure demographic data, right? We've got a bunch of younger people that are starting their lives and looking to buy a home. And partly what's driving that are interest rates. When we talk about that 1 to 4 unit interest rate, this is a historic look, which I thought this chart was interesting because this is actually off of Fannie Mae, Freddie Mac's website. And on this chart, which goes all the way back to the 70s, right, which is part of that inflation information that Anthony shared. The gray areas are where there was an inflation or where there was a recession. Okay. So we go back and we look at this, you can see that ever since we had, this kind of, mid 80s where the rates skyrocketed up, up into the high teens, they have been on a slow and steady decline ever since. And I thought this was interesting as well. For the first time ever, look at that. There's our recession, our little 2 to 3/4 recession in 2021 is officially made the chart here. And through it all, as of today, your average rate on a 30-year fixed mortgage is 2.8%. That's less than 3%. That's almost free money. And all the projections that we're seeing, although we did have a little bounce here. And listen, we've got a lot of buyers that we're dealing with, and especially in new construction where you've got elongated escrows and they complain about the rates moving, they missed out on rates. And I want to get on this chart and just say, are you really kidding me? You're concerned about this little movement in rate that you had right here? Look at how low rates are. A 1/4 of a point move is not the end of the world. It's actually still really, really low on interest rates. So, so you've got all this demand, fueled by this really, really inexpensive long-term money. So that's kind of what's behind the demand. Let's take a look at how this is impacting the actual, and we're going to start off at a national level. So again, this is NAR, National Association of Realtor Data. This is existing home sales on an annual rate. And, you can see, we've been pretty steady right around that, 5.5 million sales. And then all of a sudden, second quarter of last year, you have this radical drop. This is our recession. And I even like to, while we had an economic recession from a real estate, we didn't really have a recession. We had about a 2 to 3 month pause. Nothing, prices didn't drop, inventory levels did, everything just like froze for like 2 to 3 months because people were trying to figure out what was going to happen. And similar to how Anthony described that you had a lot of, price, I'll say discrepancies between sellers and buyers. This was happening in real estate as well. Buyers were thinking the world was coming to an end. They were terrified to buy. They were looking for really inexpensive houses, and sellers were trying to, claim that, look, this COVID thing is temporary. We don't think it's going to have a huge impact or should have a huge impact. So really what happened was nothing happened, right? Like there was just kind of this pause. And then right around May of last year is when the market just came back at a vengeance. And you'll see from a sales rate, we're going to kind of see this chart in multiple iterations, both at a state and a local and a hyper local level. But this little period between May of last year till about, what we're really going to see is up until right around now, right? We've just been on this incredible tear because all this demand that really kind of got pent up here. And then all of a sudden rates started dropping, just gets unleashed into the marketplace. And I'm going to go back to this slide real quick. The darker blue here are buyers, and you can see that the majority of buyers are under the age of 40, right? So you've got 38%. The lighter blue are sellers, right? So as people get older, younger boomers, older boomers, almost 45% of the people selling were people in their 50s and higher. Well, a lot of those people that were selling, instead of trying to make a move and sell and downsize and, sell their place and, move to other parts of the country to be with family or whatever, they didn't do anything. Everyone just sat still for almost a year. So we had this huge amount of demand, but we haven't had a lot of supply. And that's what we're going to see over and over again here in the charts. Looking at housing supply on a national level, the green line are condos, the red line are single family, and the blue is the aggregate of the two. So nationwide, we're at about a 2.6% month supply of housing. which basically means that if we were to not have any active listings and the same amount of demand in 2.5 months, we would have 0 homes for sale. A healthy market that's considered balanced is at 6 months supply. So at 6 months supply, you're meant to have kind of a balance between buyers and sellers. It's considered a neutral market. And anything that gets above 6 is where it starts to become a buyer's market. We are definitely in a seller market territory. We have been for a while. And I think we're going to continue to be, but it won't be as dominating as it has been maybe for the last 6 months. All right, so this is where things start to get interesting, right? Because what happens when you've got all this demand and very little supply? Prices start to rise. And this 19%, so right now nationwide, the median price of a home all across the country is $363,000. In January of 2021, the price was right around $305,000. In just 6 months of time, nationwide, prices have risen almost 19%. So this has been the, kind of the after effects of all this demand, all this cheap money, and then having a very limited number of homes to sell. And this is happening across the country. And part of why I'm starting to look at this across the country, it is kind of to address some of the issues of this mass migration out of California, right? Because if everyone was leaving California, they'd be leaving California and going to other markets, and we'd start to see some of that reflected in the housing data. And as we go through the slides, you're going to see that we really don't. So next up, let's take a look at California. So now I'm pulling from the California Association of Realtor data, which has great data, by the way. At the end of June, which is where all the data that I've pulled today, I pulled it by the end of June. Year over year, we're up 28%. Year to date, we're up 33%. You can see that the average price in California was $819,000 versus that $363,000 across the country. That's up almost 31%. And then our month supply of inventory in the entire state of California was at 1.7 months versus that 2.5 months that you saw in the country. This is my favorite being a realtor. Average median days on market, 8 days, right? Which, I'm sure you've all heard stories of, these huge, market goes on the, hits the MLS on Tuesday. By Friday, there's 15 offers on it, couple $100,000 over ask. Those aren't stories. That was actually happening. And that's finally starting to reverse a little bit, but that's just not in Southern California. On average, your median days on market was 8 days. I thought this was interesting. Looking at sales in California, half of it is in Southern California, and 20% up in the Bay Area, 20% in the Central Valley, and then you kind of got a smattering in some of the other more rural areas. But 47% of all homes sold are mostly in Los Angeles and San Diego, Southern California. And when we look at the sales growth by region, the Bay Area is up 34%, Southern California is up 34%. And then every region in California is up as much. But again, when people talk about the fact that, COVID's coming, everyone's going to leave the major metros, they're going to head to Idaho and, all these other smaller markets. Well, that's just not being reflected in the housing data. If anything, the major metros are where most of the growth is happening, in Southern California and in California as a whole. Looking at the price growth by segment, I thought this was really interesting. When you look at prices between $0 and $299,000, this segment is down 48%. And the only thing I can think of is that there just aren't any more properties that are under $300,000. It's just probably the pricing has moved so much, there just isn't anything left. All of those properties are now probably worth above $500,000. And I thought, what we were kind of looking at pre-COVID was that this chart right here would have been the other way around, right? The price growth was happening in the lower price segments, but as you started getting into the higher price segments, actually that's where we were starting to see kind of a change in pricing in the housing segments. And it's just the opposite ever since COVID has happened. So in that 0 to 499,000, again, this is for the whole state of California. The lighter color is 2020. The darker color is 2021. And we're up, but we're not nearly as up as we were in 2020 below 500,000. Once you get above 500,000 up into 1 million, we're up 43%. And then of course, 1 million plus, you're up 31% versus 18% in 2020. So, the upper end of the market has done really, really well during COVID, and it seems to be continuing to accelerate. Looking at levels of inventory, in June 2020, it was at 2.7 months, so almost 3 months of inventory. So, that was absolutely being impacted by COVID because all of a sudden everything just froze. Now, 1 year later, we're at 1.7 months. And again, this has been a trend that's been happening ever since, our last recession. Slowly and steadily, the actual supply of housing has been dropping. We have been talking about a supply-induced housing correction for a long time, almost for 8 years now. And, probably the primary reason is that we have a lot of older people that are living longer, living healthier, and want to age in place, right? The old philosophy of, selling and downsizing your house and moving something else, moving into, some other kind of living situation. More and more people, as they get older, their primary goal is to age in place, which means that we just don't have as much turnover because a lot of those older homes that people have lived in for a long time that are original condition and haven't been updated, that's the perfect first time home buyer property. And we just haven't had that kind of property for sale for a really long time. And I don't think that's going to change that much. We're starting to see some signs. We're starting to see a little bit of the top of this thing getting kind of cooled off for a little bit. So for the first time since May of last year, we've finally had a decrease in pending home sales. Looking at, from May, now part of it was the fact that we had such a low amount of home sales in March, in April of last year. And then May is where things started to heat up again. And we've been running full speed ever since. All of a sudden now, now that we're looking where we are right now, we don't have as many pending homes as we did a year ago. I think part of that is the fact that we've had such a huge amount of market movement in the last 6 months. And then I think part of that is the fact that we really had kind of an elevated number a year ago because people all of a sudden were starting to, make sense of what COVID is and the impact of COVID and figuring out a way to move forward in their lives. But this is the first chart we're going to see that starts to show that the market may finally be starting to level off a little bit. Here's another one, right? This is, looking at the number of homes that have sold every single month since January of 2005. And, here it is. Here's the Great Recession of 2020, the COVID recession, right? We've got this 2 to 3 month recession. And all of a sudden, right around the end of the year, things started to peak and the number of transactions, and it's slowly been clicking down. Now, again, I think part of that is the fact that we have been in a supply constrained environment. But at this point now, I think we're just starting to see that, maybe the top of the market is starting to come off. We're down 2.2% month over month on actual number of homes sold in California. And that's going to be reflected in our local market as well. And then the last chart here on California as a whole is pricing. And, as you might expect, low supply, high demand equals high prices. And sure enough, we're up almost 31% year over year on pricing. The average home in California is at $819,000. but you can see we're only up 0.2% month over month. And we were only up about 0.3% month over month in May. So all of a sudden it feels like we're starting to have a little bit of a flattening here on pricing, as well as some of the other factors that we pay attention to. All right, let's kind of start taking a look at LA County. And, you know, as you might expect, so this is everything in Los Angeles County, right? Which is everything from out in the valley all the way down to San Pedro. Year over year, we're at 36,000 sales. It has been busy. We are as busy as we've ever been, which, you know, this shows it's a 54% increase over last year. But let's be honest, last year is kind of an anomaly because of COVID. So even when we look over 2019, which was a fairly normal year, you know, we're up 24, almost 25% over the last year, and just number of homes that have been sold, close-end transactions. So, you know, this again is showing the amount of demand that we've had for LA housing in the last 3 years. This next chart is actual closed sales. Now, what the little stars are here is I want to kind of give a peek into seasonality, right? Because unlike multifamily that doesn't really have a seasonal market, even here in Southern California, where most people think it's not a very seasonal market like you would get on the East Coast, or, you know, places where you have, you know, weather, winter. We don't really have that here. But we do have a very seasonal real estate market, and all of the red stars here are where we were in June of these years. So historically, June is the peak, right? This is when we have the highest total number of transactions, which makes sense, right? All of a sudden, you come out of the holidays, and people say like, "All right, let's go. It's January. We're going to get that house on the market." Buyers are like, all right, let's go. We got to get the kids in school before the fall, get us settled. So you've got this run up in number of transactions that happens in June, and then you kind of run it back down all the way till you get to January. And this pattern has happened pretty consistently, you know, for the last, and this is only showing since 2016. I ran this chart back even, you know, for another 10 years, and it's the exact same result. Where you have the anomaly, of course, is last year, right? So because of COVID, where, you know, April and May, the entire world just stopped, we really didn't start kind of running up again until we got to October. And actually, I think this was November was when we got to the peak. And then it never really dropped down to these levels, you know, these kind of sub 4,000 units sold levels, just because the market just stayed hot all the way through the end of the year. But if we anticipate more I'll say typical seasonality happening, more than likely starting next month, we're going to start to see a bit of a drop in the number of transactions happening. And, you know, again, we're starting to feel that on the front lines, right? We just don't have the same amount of, you know, activity happening that we had 3 months ago. When we look at closed sales by price range, I thought this was really interesting. When we look at these homes that are, you know, of course, in Southern California, we don't even track things that are less than 300,000. We track things that are less than $1 million. You know, we've had almost 14,000 sales in June of 2021. Those are up 58% year over year. When we get to the million to 2 million range, there's been almost 5,000. That's up 196%. 2 to 5 million, which is the next kind of sub level, that's up 252%, and 5 million or more is up 227%. So this was, I think, telling data, because again, going into the COVID recession, these were all inverse. The lower properties were actually on a higher pace on year over year. But ever since COVID came around and people kind of started looking for bigger spaces, you know, spending more time at home and investing more in home, I think is a trend that's going to continue over the next couple of years because of COVID. And it's absolutely still being reflected in, you know, where we are on number of transactions, even, you know, by these different price segments. This chart looks at active listings. All right. So how many properties are coming on the market? And once again, where you see the red stars here, this is January of whatever year we're looking at, right? So generally January is where you kind of have the trough of the homes for sale. It builds up until you get to the middle of the year, and then it drops back down. It built up in 2017, it dropped way down in 2018, right? This is where we thought the recession was going to happen. Here it comes, but it didn't. It just got real hot again. 2019 kind of came back down to some seasonal levels here, built back up in 2019. 2020, it dropped again. And then, here we go. Right here is where we have COVID. And then just the number of active properties has just fallen off the chart, right? Because again, people, first of all, didn't know where to go, right? They didn't want to go shopping, shopping for a house, during COVID. So they just kind of sat down and kind of hunkered in. Had we had a normal type of market, then active listings would have started climbing, but instead we didn't. Active listings actually dropped out of December, because this was, if you think about it, this was really the height of COVID, right? Like, January, February, March, coming out of the holidays is when our numbers were at the highest. And it's also when active listings, which should have started to, show some seasonality and kind of peak back up, and it just never materialized, right? So we've never really we still are down way low on where we should be on the number of homes for sale. This difference right here on where we should be with active listings and where we are with active listings is what's creating this huge price increase. This is month supply, and it tells a very similar story. Generally our number of homes per month drop at the end of the year, pick up in the middle of the year. And, last year with our COVID, our COVID year, we actually had a fairly normal number of months, compared historically to the chart. But what didn't happen was in this year where we should have had an increase in the number of homes, and our actual month supply of homes should have risen, gotten us back up into kind of this more healthy 2.5 to 3.5 month supply. It actually just plummeted. We are currently in LA County down to 1.7 months of supply. And if we would have kind of continued on, this dotted line is where we should have been if we had a normal market, and instead it's gone down. And once again, this huge discrepancy here is affecting pricing. On pending sales, we are finally starting to see a little dip here at the end. Some of that could be seasonal based. Some of that could be the fact that we just don't have any inventory. Some of it could just be the fact that, we've kind of had a lot of sales here in the last 6 months, and we finally kind of pushed through some of that pent up demand from last year. But we are starting to see a little bit of a dip in pending sales. Time will tell if it's just regular, seasonally adjusted dip, or if it's a sign of something longer. Our median days on market in LA County are all the way down to 9. So, if you are looking for a home, you've got to be Johnny on the spot. When it hits the market, you've got to be ready. You've got to be prepared. You don't have a week to kind of see what happens. A week later, it's in escrow, right? So, that's one of the things that we advise our clients when we're buying is all the things that you need to do to buy a home, getting pre-qualified, getting your deposit down, all that type of stuff that you do to prepare to write an offer. You have to have it ready to go, because when a property hits the market, you need to be in there, look at it, and make a decision very, very quickly if you want to even have a shot at that property. And this has been a trend that has just been decreasing and decreasing and decreasing ever since 2016. And then lastly, what's the impact on pricing? Well, same type of thing as we saw both on a national level and a California level. Since the start of the year, the average sales price in LA County is $1.2 million, which is crazy to think about. And that it was only at $1 million, or just under $1 million at the beginning of the year. So we are up almost 22% in 6 months in LA County on sales pricing. So clear example of, basically the discrepancy we have right now between demand and supply. All right, lastly here, I got a couple slides kind of looking at some of the micro markets that we talk about. The way these are tracked is by the three largest associations kind of in the LA area. Beverly Hills, Greater LA is kind of like everything from downtown LA up to Santa Monica. Pacific West is basically everything like Long Beach kind of down to North Orange County, and the South Bay covers the South Bay. So looking at on the charts, the blue is the Beverly Hills, Greater LA area. The red is Pacific West, which is Long Beach, North Orange County, and the green is the South Bay. And then I think what's interesting is looking down here, I was actually surprised that Beverly Hills, Greater LA, they're up 88% year over year on number of transactions over last year. Long Beach area is, and the Pacific West is up almost 42%, and the South Bay is up 60%. So, of the LA area, the greatest increase in the actual number of homes that were sold were in the kind of the city of LA. So everything from, I'll say Hollywood Hills area all the way down to the South Bay has been where we've had the greatest increase in sales. Month supply kind of mimics that. You've got a little more month supply in down here in the kind of Beverly Hills, LA area. It's almost up to 2.5%, but down here in the South Bay, we're well on that kind of 1.7 to 1.3 months supply. Looking at June median price per square foot, Anthony, I'm glad you had your price per square foot looking at multifamily, right? Because this shows how much higher single family price per square foots are. Average cost price per square foot in the, we're looking about $711 in that general kind of LA, West LA area, $458, in kind of the coastal part of Southern LA. And then here in the South Bay, $612 is the median price per square foot, which is up, all are up substantially over 2020, as you might expect. And then lastly, looking at pricing, when we look at where the kind of the greater LA is, average sales price is at 1.8 million. So if you want to be on the west side, you're looking at a close to a $2 million purchase price. In that Long Beach kind of down through Huntington Beach area, you're looking at about an $800,000 is your average sale price. And then here in the South Bay, we have shot up, right? So we were kind of flat at $1 million in 2019, $1 million in 2020. And here we are at almost 1.3 in 2021, which is by far the largest, year over year increase. So there seems to be a lot of extra demand that's kind of coming into the South Bay compared to the greater LA area. I would say kind of my last thing before I turn it off, there's my info, my contact info here, is that we are seeing finally a cooling off. Now, it doesn't mean there's going to be a 3-month supply of homes and you're going to be able to write 5% under list price and snag a home. What it means is that instead of competing against 13 other buyers, you might only be competing against 3 other buyers. And instead of it going 100 to 150,000 over list, it might only be going 5 to 20,000 over list. So it's definitely still a seller's market, but it finally feels like we're starting to stabilize a little bit, here in the South Bay, LA area. And we'll, I think the expectation that we have for the rest of the year is that demand will continue. Supply will probably get a little fatter as we get through the rest of the year. But I don't think we're going to have this continued increasing in pricing. I think we're going to kind of flatten out and level off here for the rest of the year. And with that, I will stop my share and we'll open it up for questions.
I love it. So I see a couple questions on your bit here, and while it's fresh in the mind, maybe we'll cover those. So Ray had an interesting point. Like all of this is behind, what's behind all of this is a shortage of supply, basically, right? So why are people not putting their house on the market?
Because they're older people that are more afraid of COVID because death rates have been higher and infection rates have been higher, and they don't want to leave their homes. I mean, I think we all probably have elderly people in our world in their 60s and 70s that were probably more afraid of COVID than people that were in their 20s and their 30s.
Yeah.
So I think supply has really been impacted by COVID. And while it's affected older people, it really hasn't affected younger people as much. So younger people are still out there buying. They need a place to buy, but older people are not putting their houses on the market. And I think that's probably been the biggest, the biggest driver in since COVID. But again, I want to emphasize this isn't a new phenomenon. This is something that's been happening since 2010. We just have, where it used to be that the average person would recycle a home every 5 to 7 years. That number has now gone up to 7 to 10 years. So people are just staying in their homes longer. And it's not like we have all kinds of space and new construction coming on the market, to kind of help pick up this extra demand. We're still way undersupplied here in Southern California, which is why from a investor standpoint, we still believe in creating housing in Southern California for the foreseeable future, because we see there being a continued discrepancy between supply and demand over the next 5 to 7 years.
So COVID really exacerbated something that's not going anywhere anytime soon. It's not like they're all going to get comfortable and want to move all of a sudden, right?
Yeah, exactly.
Yeah, interesting. Marty, I see some questions you have on breaking down Long Beach area by area. So I will do that because you're right that the city is very different. So I'll go back to our multifamily data here. So each one of these in our market study is a pivot table and it expands. And yeah, Long Beach has everything from Belmont Shore, Belmont Heights, Bixby Knolls, super nice areas, to more, lower income parts of town. And we have a wide variety of cap rates and GRMs here. So here's what we saw this last quarter in Long Beach on apartment buildings. So Belmont Shore, this is Redondo Beach pricing basically. Same thing in Belmont Heights, 20 times gross, significant number of sales too. People like the Class A stuff in Long Beach. It's a little cheaper than like Hermosa or Manhattan, but it is expensive, 3.3 cap rate. The better cap rates in GRM, we're doing more deals. We do a lot in Wrigley, North Long Beach, Poly. Downtown is a great place to invest and still pretty reasonable. Alamitos Beach, that's generally where you're going to find your better cap rates in Long Beach if you're wanting to use debt. But you definitely have some super nice, more expensive parts of town. Bixby Knolls, often one of the most expensive areas. So you see a wide variety in Long Beach. So that's a good question on digging into the specific data there. Thought I'd show that. We can send that to people if you're interested too. And then we had questions on rent increases. I saw some discussion in the chat on whether you're maximizing the allowable increases and strategies in different areas. It's hard to make sense of what the rules are right now in the area for rent increases, because city of LA, you have a rent freeze completely. So if it's in the city of Los Angeles, you can't raise rents at all. And whereas the rest of the state you can, and it's the statewide rent control AB 1482 rules. So you can increase rents by 8.6% right now, beginning in August. So you could have delivered your notices in June and had the increases take effect in August. And that's because it's 5% plus the change in CPI from April to April. So we had a super low increase number, April to April of 19 to 20. So we were at like 5.7 because we had 5% plus 0.7. But now prices have started to come back up again. So we have this really actually pretty high cap of 8.6% right now in areas where there's not other rules about rent increases and separate rent controls. So to that question, we just did increases on a lot of our properties, and I did not take the maximum on a lot of the buildings that I have, because it was going to take the rents above market and I think cause vacancies. And so if it was a good tenant and they were paying and, not causing trouble, we took smaller increases to get them up to what we felt was market versus taking the maximum. Units that are under market though, of course, we took the absolute maximum. So, but you got to know area by area what the rules are there. So very interesting. And then I see you sent me another message here. Can you comment on demand trends for 5 and up multi-units and in Long Beach specifically? Super high demand for that stuff as well. Cap rates are really good in Long Beach compared to a lot of the rest of the LA area, especially for what you get. You can buy buildings that are less than 2 miles to the beach for, the mid 4s on a cap rate and pay about 3% for the debt, which is really hard to find anywhere else in LA. And I think our rents are also significantly below the LA averages. When you look at LA rents, like a 1-bedroom is going to be $1,700-$1,800 a lot of times, but in Long Beach it's still like $1,450, $1,500. So I think there's an opportunity there, and a lot of people are seeing that from elsewhere in the city and then coming down to Long Beach to buy. So demand there is really strong. I'm seeing better deals there than I am a lot of I pay attention to all the other markets. I keep coming back to Long Beach. So it's hard to leave it.
Anthony, we're also, even on the single family side, some of my favorite, because we do work with a lot of investors, on the fix and flip side, and even some of the buy and hold side. The single family with the garage conversion is a great play right now. Make your own duplex. It's so much easier to instead of adding a second unit, just to convert that garage. We love Long Beach, North Long Beach. We love Hawthorne. San Pedro, I think, is a huge untapped area that's got a lot of growth in it. And Lomita, actually, El Camino Village, everything kind of around where El Camino is. So Gardena, Hawthorne, Lawndale, Lomita, that area, or North Torrance around that, are some really cool communities, that are up and coming areas. For people that are looking here in the South Bay for where to potentially invest, those are some of our favorite, investor markets right now.
Yeah, I thought your slide was really interesting on median home prices from Pacific West versus LA. Kind of illustrates the same thing, that like the average price for single families in the 800s, where it's way higher up in LA. And there's a lot of nice areas down there. I mean, your commute might be, a little worse depending on where you're coming from, but yeah, properties are surprisingly cheap, and the area quality, the building quality is excellent. If I just moved to LA, these are definitely some of the neighborhoods I would be looking at right now. I mean, it is, unless you moved here to be a C-suite executive somewhere, it's pretty hard if you're coming from somewhere else. So great questions, everyone. Malcolm, do we have a Kumo space room for tonight?
Yes, let me get the link up in a second here.
So if you guys have not tried this before, as you feel free to type in some more questions if you want, but there's a funny little networking app called Kumo Space, which we use at the FIBI meetings sometimes. And it's like a virtual little bar or a living room, and you can walk around with a little thumbnail of your video and pour a virtual drink and talk. And it's kind of cool. There's a little radius that you can hear people around you. So it almost feels like a real room you can work. Malcolm's going to throw that into the chat.
And while he's doing that, Anthony, I also just put my email up here. If anyone wants to get a copy of my slides, feel free to send me an email, and I'll shoot you a PDF of what I went through today.
Dave is the absolute pro and the guy to call for your single family needs or new construction. If you're trying to get into something and you're frustrated with the market, he might have inventory coming up, which is always nice. So as you're working on getting into the Kumo space, word to the wise, we've had issues. If you stay in the Zoom meeting and then you go into Kumo space, it causes technical problems with the audio and the camera, and it often doesn't work. So copy the link that Malcolm just put in our chat, and then go ahead and leave the Zoom meeting. jump into Kumo space and hope to see everybody there. I'm going to jump over there for a little while too. So everybody, thank you so much for joining us today. Feel free to send us an email, Malcolm, Dave, myself. We can get you any of the materials. We hope to see you in person for networking on September 23rd. We'll have another virtual event in August, topic to be determined. And then both of us will see you at FIBI South Bay on August 11th as well for the coast to coast showdown. That should be a lot of fun.
Additionally, this meeting was recorded and will be uploaded to the Buckingham Investments YouTube channel. So
Awesome.
be sure to check that out. It'll be up there probably tomorrow.
All right. Thank you, Malcolm. And thank you everyone for coming. Hope to see you over in the Kumo space.
See ya.